Another storming run higher for the dollar bulls this week after a strong labor market report from the United States, and also with yields rising and the Trump trade still well and truly in effect this week. Big focus on US inflation. How is the dollar going to react? Guys, Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So guys, what a powerful run we are observing for the greenback right now. And guys, we have been all over this, haven't we? We've had our finger on the pulse with regards to those macroeconomics, those key underlying influencing themes that are driving the dollar aggressively to the north. You know, we've got the Trump trade in effect, where markets are expecting his policies, the tax cuts, the potential trade tariffs that he implements on the likes of China, Mexico, Canada, the EU, are going to be inflationary. Okay, it's going to keep the FOMC at bay from further looking at cutting rates. So on pause for now, maybe even the chance of a rate hike in 2025. And then data has just been solid, as you saw last week. Let's just quickly take a look here. Firstly, look at the greenback. 1, 2, 3, 4, 5, 6 consecutive weeks that we've been pushing to the upside here. Really, we've been pushing consecutively since the very late September. And we, as I said, we were all over this, man. Now, if we just look at last week, right? All focus was on labor market data, and labor market as a whole. Last week, the data was good. It started off kicking things off on Tuesday, setting a tone with the JOLTS job openings, a decent amount of jobs being opened. The previous was revised higher. Unemployment claims, look at that. A nice drop down to 201,000. That's low unemployment claims. Then let's just fast forward to non-farm payrolls. Look at that strong number, 256,000 jobs being added to the economy. Previous was revised slightly lower. Okay, from 227 to 212, but remember, anything north of 200k is bullish. Okay, that a number of above 200k contributes solidly to the economy, firmly to the economy. Average earnings declined as expected to 0.3%, but that's still healthy. Remember, we've had a very, very strong run of average earnings readings. So obviously people still getting paid decent money and they're spending, stimulating the prices, keeping obviously inflationary sticky. And we'll talk about inflation in a moment because that's the key focus this week. And then the unemployment rate dropped down to 4.1%. Do you know how good that is? You know how big the United States economy is? It's huge. And to have an unemployment rate of 4.1% is absolutely impressive. So with the dollar as expected, we were looking for that to pop in towards 110, and we very much did. We were just shy of that. Okay, as you can see here, the dollar index just shy of 110. But understandably, we run into a heavy area of supply here for the Dixie. As you saw here when we had this massive push in the middle of 2022 here, bam, bit of friction there before ultimately breaking through and surging to the upside. And I'm still a dollar bull. I don't see anything changing anytime soon until I would like to see these highs being challenged of 2022. I really would. Okay, now focus this week, of course, is on US inflation data, where we have PPIs, producers' prices, which are expected to remain sticky and elevated. CPI is obviously the big one. And generally speaking, expect to remain elevated on a year-on-year basis, which is very, very important because it's over the bigger picture, right? Not taking into consideration, well, not that it outweighs the monthly, because obviously monthly we have more variables there, more volatility around energy prices and food and all of that. But when you look at the longer term, the annualized, it gives us a clearer picture of where inflation's at, and it's expected to jump up to 2.9%, which is freaking inflationary and well and truly away from the FOMC's target. Remember, they want inflation down at around 2%. So if we do see that inflation number coming in higher and just inflation remaining sticky this week, allied with retail sales expected to remain solid as well, generally speaking here, unemployment claims expected to remain generally low. Nothing to me still at this stage, I'll be honest guys, I think I said it last week, but nothing to me yet screams we're going to start getting a downturn in terms of data on an economic level. I can't see it yet, because I just see through multiple macro indicators, multiple key economic data points, that there's just no reason to see that yet. Things are just healthy all around. It's incredible for the dollar. So with that being said, obviously there's a massive divergence when you look at the likes of euro. Okay, euro struggling with stagflation. We've got risks there in the Eurozone. We're trying to grind down this heavy support here around this mid 102 region. If we do, as I said to you guys before, we could have a clean run in towards parity towards one. When you look at the likes of, I'm just avoiding some of the currencies that we're going to talk about in a moment, but we look at dollar Swiss. I spoke about this before as well. This double bottom 1, 2, the neckline up here, and there's a growing economic and monetary policy divergence between the United States and Switzerland, where we've got deflation on the monthly for Switzerland. So the S&B obviously cutting the S&B, but the FOMC are not cutting. So I'm looking for this to continue to push to the upside. I'd like to see how we deal with this neckline area of supply in towards the mid 92 region. Dollar CAD as well. So we've got a bit of consolidation going on at the moment. Dollar CAD's being supported by oil prices, which have been on a rise. Can you see there? Oil prices has been on a big push to the upside due to some supply concerns, and obviously we've got the geopolitical tensions as well. But dollar CAD, if you look on a daily, we're just consolidating, potentially forming a massive bull flag. Here's all of our pole. Here's the flag, subject to another breakout. As I said to you guys before, I'd like to see it challenging these highs here of 2016 and these highs of 2020. Obviously, this is not financial advice. It's just my opinion, guys. Take it as per your wish. And this is just what I'm observing here. And at the end of the day, Canada is in a bit of a tricky situation as well, given the political instability, given the potential tariffs incoming from Trump, all of that. So anyway, back to the dollar. I am well and truly remaining a dollar bull this week. The pound is in the spotlight again. It has been within recent times because we've seen heavy downside pressure for the UK economy, for GBP. And there's a lot of worries, around the UK economy with government finances. Government finances are a mess. There's a lack of confidence in the UK government. Public debt levels creeping up. It's just not in a great place, and we've seen yields rising. In the United States, I've been saying this a lot to the trading community. In the United States, how yields are rising, but the economy is pretty damn sound, right? From multiple avenues. So obviously, a foreign investor gets a higher rate of return because we're expecting inflation in the United States, but the economy's solid, right? So it can somewhat deal with that higher inflation because the economy's warm. So higher yields being offered in anticipation of higher rates for longer in the United States. So it's not disrupting foreign flows coming in. Foreign investors are going to be attracted to that higher yield, right? They get a greater return on their investment. But for example, in the UK, the yields are rising for the wrong reasons because there's uncertainty around obviously rising inflation, a slowing down in the economy, and the uncertainty around the government finances. So as a foreign investor, you're going to be reluctant to want to invest in the United Kingdom because of that. So yields rise to accommodate that higher risk. All right, there's higher risk there. So not like the United States situation. This is slightly different, where yields are rising because of uncertainty. So a foreign investor is demanding more yield to go and invest in that riskier economy. I hope that makes sense. It's the same in the Eurozone as well. You're seeing yields rising at the moment in the Eurozone on that same sort of reason, more or less, because they have a situation of stagflation and low growth, and there's uncertainty politically, the likes of Germany, France. Anyway, with GU, we've come down to this massive demand area. Remember we were noting this last week, 122. Okay, there is some demand here when you drag this all the way along this zone. If we're able to break this down, obviously this could be a little bit tricky. But if and once we break this down, that where we're heading, we're going to head in cleanly into 121. Now, this week in terms of data, we're going to keep an eye on UK CPI. Expect to remain sticky at 2.6%. This isn't a good thing, okay, because it goes back to what I was saying about before about the economic uncertainty and the stagflation situation. GDP expected to pick up after last month's reading was poor in a contraction of 0.1. Expected to pick up to 0.2%. And retail sales expecting a number of 0.4%. Most likely helped by seasonality aspects in terms of end of the year spending, Christmas, all of that stuff, holiday periods. For me, I am still risks to the downside for the pound in generally speaking, especially obviously versus the dollar. The dollar's so dominant right now. So obviously these numbers are going to be very much dependent on whether GU gets that breakout and retest of this 22 figure to see us dropping down 100 pips to 121. So do keep an eye on those figures this week from the UK. Australian dollar is going to be facing some volatility this week because we have domestic data, but we also have data from China. But let's start off with Australia first of all. Last week, guys, you saw inflation remain sticky at 2.3%, which is one of the reasons we know the RBA are keeping standing pat at the moment and not entertaining the idea of rate cuts for now. Okay, retail sales was poor, coming in at 0.8%, lower than the expected of 1% lower, and the previous was even revised lower down to 0.5%, which is a little bit obviously concerning. Okay, consumers aren't spending, retailers obviously aren't performing well. So those retail sales were down. So do we maybe have, obviously it's still quite early to say, but do we maybe have a potential situation as well, this economic downturn? Do we maybe have a situation of stagflation? Okay, it seems a number of economies are struggling with high prices and lower growth. So let's see. Anyway, this week we're going to be keeping an eye on key labour market data. Last month was really good from Australia. We had the unemployment rate dropping down to 3.9%. Expect to tick higher again this time around to 4%. We're expecting less employment change, 14.5 thousand. Obviously, last month was 35.6. Obviously, these numbers will further ramp up rate cut pricing if they do come out to the downside. Obviously, Australian dollar is vulnerable at the moment to the downside risks of the Chinese economy and the uncertainty there. And especially, we haven't even had the tariffs yet. So that would be alarming. We do have Chinese GDP expected to pick up to 5%. Obviously, that last reading was poor. Industrial production expected to remain steady. And retail sales expected to pick up. Now, do note that obviously we've had deflation in China with certain readings, like PPI's prices falling because people aren't spending. So could we perhaps see this number disappointed to the downside? It's possible. If we take a look at AUD, obviously we've been trending to the downside quite nicely. We've been all over this move to the south, broken down a key demand area here at 6200. What I like here is we've broken out a bit of a range, a bit of a pennant that we had here. You could mark up a trend line there. And you could more or less mark up a bit of a trend line here. Not the cleanest of, but you can see a bit of a pennant, bit of a triangular structure, which we're breaking out of a range anyway. And obviously subject to some further downside. I had a bit of breakout. Maybe we get a bit more of a retest there for rejections at that sort of 6180 area, there or thereabouts. But as I said to you guys last week, this looks vulnerable for a drop into 5500. Go and feel that wick and go and test those lows of the pandemic. So once again, when we look at the calendar here as a whole, there is a lot of good stuff this week, a lot of volatility across the board. Oh, bear with me one moment. Let's put this up again. Next week. Yeah, look at that. Plenty of high impact data for us to be watching, and obviously to bring some nice volatility to the markets for us. So once again, have an amazing and blessed week, and I'll catch you in the next video.